Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel. It's time to talk a little bit more about tax planning. We recently had the One Big Beautiful Bill passed, and regardless of anybody's opinion on it, it unfortunately adds additional layers of complexity to tax planning. In fact, I was talking with a fellow financial planner just earlier today just about different tools that we are using, different pieces of software, how we're looking at tax planning. And he mentioned that previously, for some simpler tax plans, he was just using Excel, which is totally fine, and you can do that. But even he said, anymore, no way, no chance. It was challenging enough before. All it takes is one little oversight or formula error, and especially with the new bill that's passed, you could have a pretty significant screw up trying to do it manually because it really is just that complex now with all the different levels that were added. There's lots of different income phase out ranges for different items in there now. So unfortunately, they're not all the same. We used to be able to just focus on income tax brackets and Medicare IRMA brackets. And if somebody was too young to be on Medicare, we'd have to look at what's the health insurance subsidy, things like that. So there was still plenty to plan around previously. Now you have different income phase outs on itemized deductions or the extra standard deduction for seniors. And so almost every important addition or change in that bill came with an income phase out at a different range from the other item in the bill. This is more just a warning that if you're going to do tax planning as a do-it-yourself item, you absolutely still can, but you have to be really, really careful and dive into detail on where these income phase outs are, because they're all going to have an impact on the decisions you make around tax planning. Now, when we're looking at Roth IRA conversions, for example, again, before we looked at tax brackets, Medicare IRMA, health insurance, if that was a concern under age 65 pre-Medicare, we'd be looking at those items. And that, again, that's a lot, just looking at those. Now we have to look at extra standard deduction. We might have to look at, depending on what state they're in, if the state deduction, state and local tax deduction, will that get phased out at a higher income level? We have to look at all these different pieces now. And it's not a complaint, it just is what it is. And it's more of a warning or a word of caution for those who are trying to just do this manually on their own. Absolutely, it's possible. It's just going to be really, really difficult. And that's why different pieces of software exist. And that's why even the CPAs and the financial planners use that software, because that's already all built in and programmed to where it can handle that logic and understand where the opportunities are, where the red flags are, and how to best prioritize different strategies. Even in the past, it was challenging. We had somebody come in a couple of years ago looking for our help. And if you look at the tax return, he actually prepared it on paper. It was a married couple, but the gentleman prepared it on paper by hand, the old school way, because it was, in theory, a very simple tax return. They had Social Security, they had some income from IRAs, 1099R, and a little bit, they have some interest as well, so 1099 INT, but they also had a relatively small W-2. So you think of these things, you're like, all right, W-2, great, interest, cool, easy, 1099R, that's fine. Yep, we got Social Security. We'll calculate how much of that's taxed because their income just in total wasn't that high. But that income not being high actually triggered something, because when we were talking about their planning, they talked about the W-2 they had, and they said, oh, well, that W-2, we just take that money and put it into our IRA. If you don't know this specific rule, you wouldn't have caught this, and they didn't catch it. It was a retirement savers tax credit. So if you are someone whose income is low enough and you're still putting money into a retirement account, you can be eligible for a retirement savers tax credit. They didn't have that on the return, because if you're doing it manually, how would you know? You have to know that specific rule and find the form that goes with that, and then plug that into the tax return. Uh, so I can't blame them for missing it at all. I mean, again, it's not really something that we specialize a lot even, but I knew about it and I went, hey, there's something here, and we wound up, amending their tax return and taking care of that. But that was missed for several years. That's a lot of money that would have been left on the table just because there's this one semi obscure rule that provided a retirement savings tax credit because of where their income fell and because they had a W-2 and they were taking that W-2 money and applying it to the IRA. So, just an example to say, here's something that seemed really simple: small W-2, interest, a little bit from a 1099-R for retirement distributions, and Social Security. Most of the time you think, yeah, slam dunk, easy return, no problem. Unfortunately, we just never know when there's going to be some little wrinkle in there that we need to pay attention to on a specific rule. So if you're doing the tax planning yourself, please be careful. Please make sure you really, really know all the different opportunities and rules around that. Otherwise, it's going to be easy to miss something. And that's unfortunately bad news. I wish the tax code were simpler. I know somebody was joking with me a while back about, oh, hey, all this tax complexity keeps you employed. I said, oh, we'd have enough tax planning even without the extra complexity, thanks. So we can hold our breath and hope that someday they will simplify the tax code. I don't see that happening anytime soon, unfortunately. In fact, how powerful software is actually allows them to make this tax code more complex. If they had been doing this in the 80s or even the 90s, they'd have the accounting and tax industry screaming at them, and they'd probably have to pare back some of the rules just because there really would be no way to process the returns. The IRS wouldn't have any way to actually handle all that information and all those details. So the technology and the software actually, in a way, enables them to make this tax code more complex. So that's just where we are. So again, just one more time, a word of warning: if you're going to do it yourself tax plan, yes, it's possible. Please make sure you're diving into all the details and knowing all the opportunities or things that could be missed, because there's a lot of variables that play into each other, and we have to make sure that we know those, or that we have a good piece of software to help us identify those and understand what the planning opportunities are.